Schwab's Large Cap Growth ETF, SCHG. The main premise of the fund is a straightforward, low-cost fund offering potential tax efficiency, as well as simply finding access to large cap U.S. equities that exhibit growth-styled characteristics. The reason why this fund is important is not only that it has a 0.04% expense ratio, but it's been around since 2009. The reason why that's important is if you have a fund that's only been around for 1 or 2 years, it really might or might not have gone through a full market cycle where you experience a downturn. The reason why that would be important is you want to be able to mentally and emotionally prepare for downturns, just because it's not going to be pleasant, it's not going to be pretty, and you really want to know that a fund will come out of it and just doesn't get liquidated. So if it has a history of, it has gone through a recession, it has, not performed well, but then, later on came out of it, simply from this year, minus 31.81 going to 50.2.12, that can really give you an overall indicator of whether this fund has long-term potentiality. When we look down here, one of the interesting things and what people have been searching for and what is important for SCHG is mostly what is it invested in. Well, when we look, it's information technologies, consumer discretionary, customer services, healthcare, financials, up to 45% of the fund. The reason why that's important is a lot of competitors, which people have been also searching up, are basically also oriented around tech and consumer discretionary. The specific holdings that SCHD has, when we look up here, portfolio, it's mostly been Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, both Class A and C, and then various other companies. And when we look at the other competitors that are also being observed, we have VUG, which is basically similar, Invesco, similar, Apple, Microsoft, Amazon, the works. So with that information in mind, is definitely more of a information technologies focused, which is primarily why you would choose a growth over a value fund or just the S&P 500. Now, comparing all these different funds of what people have been searching up, we can do a back test. Based on this back test below, we're going to make some assumptions. $10,000, no rebalancing. Just imagine somebody invested theoretically $10,000 into either QQQ, SCHG, VUG, SCHD. Okay. When we analyze the portfolio, over the 12-year span from 2012 to 2024, we would have seen an initial balance of $10,000 grow to about $64,000 and some change, making a total aggregate return of about 16.66% with a moderate amount of standard deviation. The best performing one was by far the Invesco QQQ, 10,000 growing to 83,000, but that also comes with higher volatility and a higher max drawdown of about 32.58%. Although when you compare it to SCHG, a 1% difference in max drawdown versus a difference of about a 3% annualized return, you can see that differential opening up in comparison with one another of about $20,000 worth of just those small percentages compounding over time. So that's something to look into. There are also alternative funds to QQQ that are a little bit less expensive in terms of their expense ratio, because QQQ has a 0.2% expense ratio. VGT is one of them. Basically has a 0.1%. expense ratio, and there's also a Fidelity fund that has a 0.08% expense ratio that has performed similarly to Invesco QQQ. When we look here, some people also look up dividend yields for these various type of funds. So just looking in aggregate here, we can see that SCHG has a dividend yield of about 0.45%. You can also see the 30-day SECT yield if you just go on the Charles Schwab website. They normally post it, as well as seeing whether or not a fund is selling at or above the basically discounted or at a premium compared to what their ETF is. When we look at the competitors, Invesco QQQ has a larger dividend yield of about 0.61%. So, and then you also have the Vanguard Growth Index, which has kind of splits it down the middle in terms of what dividend yield that has. And then when we look at SCHD, it blows them out of the water at a dividend yield of about 3.49%. Although it's difficult to compare dividend-oriented ETFs with growth ETFs because they have different targets that they're performance targets that they're looking after. So it's not a fair comparison, but it is something that people are looking up. So keep that in mind. It's always good to have a financial professional that is certified. Remember, this is not financial advice, but it's always have a good third party who is certified to assist you if, because everybody's situation is different and they'll be able to tailor something specific to you. All right. But let's see here. Now, normally people do not just invest in the market and $10,000 and then they do nothing else with it. Normally, a lot of people invest with dollar cost averaging. So what we did here is using the same portfolio visualizer, we did a Monte Carlo simulation. So $10,000 initially plus $2,500 contribution amount every month based on the statistical returns that it's had spin. What we'll see is that in the bottom percentile, the end portfolio balance of about $6,600,000. Then we look at something that's a little bit more on par with what we saw in the fact sheet or since inception date returns, about 15. You'd get a more realistic picture of what might happen. Remember, forecasts always tend to be wrong, but it's good to know what is possible just so that you can, see whether it's of value to you. Everybody says that the past has no bearing on whether the future will return, but that's always the first thing that they throw in your face. So when we see here, an ending balance of about $19 million, that's nothing to sneeze at. Now this is a little bit less realistic, having 20% annualized returns over a 30-year period. Definitely not as realistic, but this number matches the inception date, or at least closely aligned, so that should give you an idea of about what might happen, not guaranteed, as well as if it underperforms, that it still wouldn't be too bad. So now we're going to skip to what people would frequently ask, just based on what people are searching for in relation to SCHG. VTI is an interesting one. It's like the total stock index. It's either that VGT. It's either one of those. One of them is a total stock index. It's similar to the VU or the Vanguard S&P 500. The S&P 500 has outperformed it over these 12 years, so it's not really a big difference. VU slightly outperformed SCHD, just to give you some perspective on where those numbers were before. VGT is basically a cheaper alternative of QQQ. Some people will disagree, but when you look at their numbers, they're pretty much the same thing in terms of return basis, and that's what people really care about. They don't really care about what words you use to describe funds. The forecast, In terms of forecasting the future, a lot of people are always wrong, but since based on the fact that he's gone through recessions before, it is a growth fund, as similar growth funds have gone through the same types of recessions, they haven't been liquidated. It'll probably go up and to the right, similarly with other growth funds in the same niche. We already talked about performance. SCHG, that looks like a misspelling. VTI, ETF holdings, good, we talked about that. SPY is more expensive than VU. SPY has an expense ratio of 0.09%. So if you're looking for an S&P 500 clone, you would probably want to look at Fidelity. Fidelity has some, I think it's VXIAX, has an expense ratio of 0.015%, which is one of the cheapest ETFs or index funds about the S&P 500 that I could find. They basically are all very similar. It's just how much you're paying for it. So SPY is expensive compared to them, so you'd probably want to look into Fidelity or Vanguard if you were so inclined. SCHG stock splits don't really matter. It's not really liquidating. Dividend history, that's interesting. So when you look at dividend history, you can always look at Seeking Alpha. So with dividends, when you look into Seeking Alpha, you can see exactly when these dividends are issued. So you can see dividends, you can see dividend growth. See? And also on the fact sheet, it tells you when these dividends are issued. I believe it's every quarter, what it said. When we look at the fact sheet, let's see. Yep, distributions frequently quarterly. So that'll give you that inclination of when they issue dividends and also how often they issue them and how much they did, and especially with the history. So if you, I know this is a growth oriented, but some people like the fact that they get dividends as well, and they want to know when those are or approximately when they are. Here's the history. You just go to Seeking Alpha and you can just plug that information in and download this to a spreadsheet. There's also, if you use Yahoo Finance, you can also download the historical data, so you can look up the price data. So I don't know who's traders or who's investors, but if that was something that goes into your analytics or your analysis, you can always download the historical data here. You just do your start date, your end date, and then hit apply, and it'll download it straight to an Excel spreadsheet for you. Morningstar. MGK is very interesting. MGK actually outperforms, if we just do the back test right here, we'll get rid of this one. MGK crushes. Actually, MGK is pretty similar. Thought it did. Thought that was a different one. So that's interesting. The Mega Cap Growth Fund is pretty similar to the Charles Schwab. But the interesting thing about that, let me see. Nope. When you pull up MGK, you do have an expense ratio that's just a little bit higher, but interesting. So you have Mega Cap, which just slightly outperformed, but when you look at the expense ratio, is it really worth the increased expense ratio? Theoretically, yes, because it's only a 0.01% difference. So NGK might be an alternative if you're just simply trying to go for more, but you are trading about 2% just based on this back test for maximum drawdown historically. So that might be an interesting comparison. Let's see. QQQM is a cheaper alternative to QQQ by about 25%. It's basically, instead of the entire NASDAQ that they're indexing, they're only indexing the top 100. And basically they return about the same with the same volatility, the same risk profile. So it's just 25% cheaper than QQQ. It's only been around for about 2 to 3 years, so it doesn't have a long track record, but when you put them in Portfolio Visualizer, you'll see it. Yeah. We talked about the annual return of SCHD's annual return. So cool. If there's any other funds that you'd like me to dig into, or I will be making a report on the Financial Reporter on the Quora site that I have here, you just hit follow. And then I make content similarly in veins with different verses and different other ETFs. So go ahead and subscribe right now, and then I'll see you on Quora. Take care.